Hello, everyone, and welcome to another episode of my market talk. So, recently, Grab has just announced its quarter two 2023 results. So, today I would like to be comparing Grab's quarter two 2023 results to Uber's quarter two 2023 results. And we compare both the company's business and fundamentals relative to its valuations. You will be shocked at these findings. So if you're interested to see what we have found, come let's dive in to see what I've discovered. Of course, do remember to smash the like button and subscribe if you want to have more insights about investment ideas going forward. Alright, without further ado, let's start. Okay, so I would first like to mention that I do not own both Grab or Uber stock. Anyways, let's take a look at Grab's mobility revenue. It increased 31% year on year on a constant currency basis. This current quarter two 2023 versus quarter two 2022. By the way, constant currency is a measure that is a popular metric used by tech companies in recent years. So constant currency removes away growth without accounting for currency risk. I normally do not like to use this measure for my valuations, but for comparison's sake today, I will be looking at this metric. While its GMV or gross merchandise value on its mobility business increased by 30% year on year this quarter on a constant currency basis, its mobility EBITDA increased by 21% year on year. So let's do a orange for orange comparison with a similar player within Grab's industry. We shall now look at Uber's segmental results for quarter two 2023. Uber's revenue increased by 40% year on year on a constant currency basis, beating Grab by a huge margin. While gross merchandise value or GMV increased by 28% year on year on a constant currency basis. This, however, is slightly below Grab. EBITDA increased 70% year on year, also beating Grab by a huge margin. So for the delivery segment, Grab's revenue went up by 126% on a constant currency basis year on year. Gross merchandise value or GMV increased by 7% on a constant currency basis year on year, while EBITDA for this segment increased only 2.7% year on year. Okay, if you look at Uber's delivery segment, okay, as comparison, revenue went up by 17% year on year on a constant currency basis, losing out to Grab by a huge margin for this one. Gross merchandise value is up 14% year on year on a constant currency basis, beating Grab by only a 7% margin, which is quite slight for this segment for their GMV. Okay, EBITDA grew 2.1%, and this is almost similar to Grab's growth. Okay, now let's take a look at Grab's current quarter's total consolidated profit and loss. You can see here that Grab's revenue for 6 months ended 2023 increased 50% year on year, which is indeed a huge jump in revenue. Cost of revenue increased by 13% year on year. Total expenses increased by 0.6% year on year, which is indeed very good in terms of managing their expenses. This included a reduction of delivery incentives for drivers to hit their current KPIs for Grab. The huge revenue jump and slower increase in expenses led to a reduction in losses year on year. Especially you can see this in the current quarter. Okay, however, for Uber, let's take a look at its current quarter's total consolidated P&L. Uber's total revenue for 6 months ended 2023 increased by 17% year on year, which is less than Grab's increase. Cost of revenue increased by 15% year on year. Total expenses increased by 10% year on year, of which Grab have seemed to manage to do better in terms of cost management compared to Uber. But despite this, Uber managed to turn in a profit this quarter because Uber is in a position that is larger in scale and is able to leverage on its economies to turn in a small profit this quarter. We noted that the percentage of total expenses to revenue for Uber was 37%, while for Grab, it was 65%. Let's take a look at Grab's cash flow statement now. Grab's operational cash flow for both consecutive years, are negative. However, Grab has managed to receive a one-time cash inflow this year from its investments of $1.2 billion. I could not really find the information of where this one-time cash inflow came from what investment, because there's no details so far mentioned in their notes to the financial statements, because it's quite a short one. All right, but there's this $1.2 billion cash inflow. I will see if they will give more information when the time comes, and we will take a look at it. What this cash inflow came from for this quarter. Anyway, we know that historically Grab has been burning cash really aggressively, right? Okay, while we now look at Uber's cash flow statement, Uber's operational cash flow for both consecutive years are positive. And because of its low required capital expenditures, we saw that in both years during the same period, Uber managed to achieve positive free cash flows. This allowed Uber to slow down its cash burn and may even use funds to pay off debts or buy back shares to increase their shareholders' earnings. Of which we also know that Uber's outstanding shares in the market currently is much lesser than Grab's. Okay, now we compare both their current valuations. If we look at the multiples matrix, Grab's current price to forward top end estimate for revenue, okay, is 13 times. While if you look at Uber's current price to its forward low end, okay, I took Grab's high end estimates, while I took Uber's low end estimate to just give a comparison, right, of who is actually more over or undervalued. So Uber's current price to its forward low end estimate is only 2.42 times, while Grab is at 13 times its high end estimates. Grab's current price to its trailing 6-month revenue is at 13 times multiples, while Uber's current price to its trailing 6-month revenue is at current 5 times multiples. To date, we know that Uber's outstanding shares is 2 billion shares, while Grab's outstanding shares has 3.8 billion, resulting in more dilution for Grab shareholders. I, however, did not attempt to do a discounted cash flow valuation here for both companies due to their cyclical and uncertain nature for their future cash flows and earnings. Doing so will make the value unreliable anyways. In conclusion, we can see that Grab has definitely commanded a premium if compared to its largest peer. Here, I must also say that Uber holds a 13% stake in Grab. This means that Grab supporters believe that Grab can continue to grow in a faster pace than Uber and eventually become not only EBITDA profitable, but also profitable to the common shareholder. I think this is a tall order to fulfill in the long run, as Grab will either need to break an arm and a leg to perform such growth, or be able to keep acquiring strategic partners at wonderful prices to be able to achieve continued growth while keeping expenses in check. We also bear in mind that Grab to date still has a large cash burn. At current prices, for me, I think Grab is already speculative, and that Uber will be a better bet. But do I believe in the Grab and Uber type of business model as of current? I would say no for now, because its business nature is rather fluid, and I mentioned in my previous videos, if you haven't checked it out, do check it out, right? About Grab's acquisition of Transcab Taxi. That the challenge in this business is manpower. Delivery drivers are both Grab and Uber's prime assets. Should their incentives fall and a new competitor comes in with better incentives, driver will definitely jump to the next company. I mean, for drivers, there's no stickiness factor to make them stay, right? This will then lead to poor customer service levels and eventually higher customer attrition rates. It is therefore hard to predict who the winner will be in the long run. So I will stay away for now unless prices turn so attractive that it becomes hard to ignore, because by then the risk will be so low that even if I did get it wrong in my predictions, my purchase price will not turn sour so bad so quickly. However, if I had a choice though, I will still choose to take a position in Uber instead if prices correct sharply. But for now, at current prices, it is still too risky for me to take any position. So anyway guys, that's all for now, and I'll see you in the next episode. For now, stay safe for the win and hope you guys make much money this current quarter, alright? And hopefully this week we will see good market returns for the S&P 500 and the US market. Take care. Bye.